Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world, even when companies try to hide in plain sight with tricky financial jargon. Today we're diving into Glucotrack Inc.'s latest report, and let's just say they've made a deal that's got cash flowing sort of. This report is a Form 8K, which is basically a company's way of telling the world about really big, important things that happen outside of their regular financial reports. Think of it as a crucial news update. Glucotrack Inc. is telling us about a significant deal they just inked on September 12, 2025. It's not a normal business day when a company talks about borrowing money through a special kind of note. Now, Glucotrack's main business seems to involve common stock traded on the Nasdaq Stock Market LLC under the symbol GCTK. That's the stuff you can buy and sell if you're a regular investor. The main story here is a new agreement called a note purchase agreement. It's like a handshake dealing for borrowing money in a more private way than the usual public loans. Here's the juicy detail. Glucotrack issued something called a convertible promissory note. That means they borrowed money, specifically $1,600,000, but they didn't get the full amount up front. They got $3,000 for this $3.6 million note. This difference of $600,000 is called an original issue discount. Think of it like buying something at a lower price than its ticketed value. The company effectively got $600,000 less than the face value of the note because it's a way to sweeten the deal for the lender. This loan has a deadline. It's due in 12 months or by the time they close a big new funding round, so it's a short-term loan basically. What's interesting is how this debt can be handled. If Glucotrack manages to raise at least $5 million in a new stock sale, which they call a qualified financing, they have an option. The person or company who lent them the money, the holder, can choose to turn this debt into actual shares of Glucotrack stock at the price of that new funding round. However, there's a safety net for Glucotrack. The price they convert the debt into stock won't go below 4.87 cents per share. This is known as the floor price, and it protects them from highly unfavorable conversion terms if their stock price tanks before they can raise that larger amount. Now, bringing in another piece of the puzzle, Glucotrack also has a deal with Sixborough Capital Fund, an equity line of credit or ELOC. This means Glucotrack can, if it chooses, sell up to $20 million of its stock to Sixborough. Here's how the note and the ELOC are connected. Initially, Glucotrack has to use all the money it gets from selling stock through this ELOC to pay back this new $3.6 million note. This is a pretty strong commitment to clearing this specific debt first. This repayment rule using 100% of the proceeds continues until Glucotrack gets approval from its shareholders. This approval is related to something called the exchange cap, which likely refers to limits on how much stock they can sell without triggering certain registration requirements or other investor-related rules. Once they get that shareholder approval, they only have to use half of the money from the ELOC sales to pay back this note. So it's a phased approach to debt repayment tied to their ability to raise more capital and get shareholder buy-in. Like any loan, there are conditions that, if broken, mean the lender can demand all the money back immediately. These usually involve things like bankruptcy or financial troubles for the company. Interestingly, this note doesn't seem to have any specific promises from Glucotrack about what they must do or must not do, beyond repaying the loan. Usually lenders include covenants to protect their investment. This whole deal was done as a private placement, meaning it wasn't offered to the general public but to a specific selected investor. They're relying on an exemption from having to register the sale with regulators, which often applies to deals with sophisticated investors. This section just basically says, hey, we've got a new financial obligation, and it points back to the details in item 1.1, which we just covered. It confirms that this note is a real debt the company owes. This part is about selling stock without registering it publicly. Again, it refers back to the information in item 1101, confirming that this note deal and any stock potentially issued from it is being done under exemptions that avoid public registration. The investor who bought this note also made specific promises, like confirming they are an accredited investor. This is a legal term for individuals or entities that meet certain income or net worth thresholds, suggesting they are financially sophisticated enough to understand the risks of private investments. This is the housekeeping section where they list the actual documents that support everything they've said in the report. they've attached the actual form of the convertible note itself as Exhibit 4.1. This is the legal document that details all the terms and conditions of the loan. In the note purchase agreement, the deal to buy and sell that note is attached as Exhibit 10.1. These are the core contracts backing this announcement. And lastly, Exhibit 104 is the interactive data file for the cover page. This is for regulatory tech purposes, allowing computers to easily read the basic info on the first page. Finally, the report is signed off by Paul Good, the Chief Executive Officer of Glucotrack, on September 12, 2025. This shows the company's top leadership is aware of and responsible for this filing. So what's the big picture here for Glucotrack? They've secured $3 million through a short-term convertible note, which means they can raise cash quickly without traditional bank loans. But they might have to issue stock later at a predetermined price. The $600,000 discount is a cost of doing business for quicker access to funds. Their strategy seems to be using this note to bridge funding until they can nail a larger equity round. The connection to the $20 million equity line of credit is key, as it's the expected source for repaying this debt. It shows a plan, but also a dependence on future fundraising success and shareholder approval. The real test will be if they can hit those funding targets and manage their shareholder base effectively. If they don't, this note could become a short-term drag. It's a move that signals a need for cash, but with a clear, albeit conditional, path to resolving the debt. Alright, that's our breakdown of Glucotrack's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.